If you're a small business owner and you feel like your business is making money, but somehow your bank account never seems to reflect that, you're not alone. This is one of the most common and most frustrating experiences that I hear from entrepreneurs. And today I want to give you a framework that's going to completely change how you think about the money in your business. I'm Dan. I'm a CPA and I work specifically with small business owners and entrepreneurs. And today we're going to talk about the four types of money that flow through every business: income, profit, flow, and equity. These four concepts come from a book called The E-Myth Accountant. And I promise you, once you understand these four distinctions, you will never look at your financials the same way again. So let's get into it. Here's the problem. Most small business owners were never taught how to think about money inside a business. They were taught, maybe in school or maybe just through life, how to think about money as an individual. You earn a paycheck, you pay your bills. Whatever's left over is yours. Simple. But a business doesn't work that way. Money enters a business in different forms. It plays different roles. And if you treat all of it the same way, you're going to make decisions that hurt you. I see it all the time. A business owner has a great month, revenue is up, they feel good, so they take a big distribution, or they buy new equipment, or they hire someone. And then 2 months later, they're scrambling to make payroll and they can't pay a vendor. What happened? They treated all the money in their business as one lump sum, and they didn't understand that different dollars have different jobs. That's what the four types of money framework solves. It gives every dollar in your business a job title. And when you know the job of every dollar, you stop making emotional financial decisions and you start making strategic ones. The first type of money is income. And this one seems obvious. Income is the money your business brings in, right? Sales, revenue, whatever you want to call it. But here's what most business owners miss about income. Income is not yours. Let me say that again. When a dollar comes into your business as income, that dollar does not belong to you. Not yet. It belongs to the business. It has obligations attached to it: cost of goods, overhead, taxes, employees. Income is the gross number, the starting line, not the finish line. The mistake I see entrepreneurs make is that they look at the revenue number and they feel wealthy. They see $50,000 come in for the month and they think, I'm doing great. But they haven't accounted for the $35,000 it cost to generate that $50,000. Revenue is a vanity metric if you don't understand what comes after it. Now, income does matter. Don't get me wrong. You can't have a healthy business without strong revenue. But income is really just the engine. It's what makes everything else possible. And your job as a business owner is to manage income strategically, to control the costs associated with generating it. One practical thing you should be doing: track your income by source. Know which products, which services, which clients, or which channels are generating the most revenue. Because not all income is created equal. And we'll get to why that matters more when we talk about profit. The second type of money is profit. And profit is where things start to get interesting, and also where a lot of business owners get tripped up. Profit is what remains after all the costs of doing business are paid. Revenue minus expenses equals profit. On paper, this sounds simple, but here's the mindset shift I want you to make. Profit is not an accident. Profit is a decision. In the E-Myth account framework, profit isn't just what's left over at the end of the year after everything else gets paid. Profit is something you plan for. You decide in advance what percentage of your revenue you're going to keep as profit, and you build your business model around that decision. This is actually the core idea behind a popular book called Profit First by Mike Michalowicz, which aligns really well with this framework from the E-Myth. The idea is that you take your profit out first before you pay expenses, before you pay yourself, before anything. You make a profit a priority, not an afterthought. Now, why does this matter? Because profit serves a specific purpose in your business. Profit is your cushion. It's what allows your business to survive a slow month, a surprise expense, an economic downturn. It's retained earnings. It's the financial resilience of your business. And here's something I want every business owner to hear. If your business is not consistently generating profit, your business is not sustainable. You might be generating income. You might even be paying yourself, but without profit, you have no buffer. And one bad quarter can wipe you out. So the question to ask yourself is, what's my target profit margin? And am I consistently hitting it? For most small service-based businesses, a healthy net profit margin is somewhere in the 10 to 20% range. For product-based businesses, it varies, but you need a target. Now, here's the one that catches most business owners completely off guard. And honestly, this is the one I spend the most time on with my clients. The third type of money is flow. And this is all about cash flow. Here's the most important thing I can tell you about cash flow. A business can be profitable and still run out of cash. Read that again. You can have a profitable business on paper. Your income statement looks great, and you can still not be able to pay your bills. This happens more than you think, and it's the number one reason small businesses fail. How is this possible? Well, because profit is an accounting concept. Cash flow is reality. Let me give you an example. Let's say you're a contractor. You complete a big job in January, $40,000 worth of work. You invoice your client. Your income statement shows 40,000 in revenue for January, but your client has a 60-day payment term. So you don't actually receive that cash until March. Meanwhile, you had to pay your crew in January, buy materials in January, cover your overhead in January. You're profitable, but your cash flow is negative. That gap between when you earn money and when you receive it is called the cash flow cycle. And managing it is a completely different skill from managing profit. So, what does healthy flow look like? It means you always have enough cash on hand to cover your near term obligations, payroll, rent, vendor payments, without relying on a line of credit or stressing every time a big bill comes due. A common rule of thumb is to keep 2 to 3 months of operating expenses in a dedicated cash reserve. Here are three practical things you can do to improve your flow right now. First, tight, tighten your receivables. Send invoices immediately. Shorten your payment terms and follow up on overdue accounts without hesitation. Second, extend your payables strategically. If a vendor offers you net 30 terms, use them. Don't pay early unless there's a discount. And third, do a 13-week cash flow forecast. Every week, look 13 weeks out and project what cash is coming in and what's going out. This gives you visibility and time to act before a cash crunch hits. The fourth type of money is equity. And this one is really about the long game. Equity is the total value of your business, what it would be worth if you sold it today, minus what you owe. Think of it as this way. Income is what your business makes today. Profit is what it keeps. Flow is how it breathes, but equity is what it's worth. Equity is the wealth building component of business ownership. And here's why this matters for entrepreneurs specifically. Most small business owners think of their business as a way to generate income for themselves. And it absolutely is that. But if you build it right, your business is also one of the most powerful wealth building vehicles available to you. Think of it as an investment. A profitable, well run business with strong systems and recurring revenue has real market value, and that value is equity. So, how do you build equity? There are a few key drivers. First, consistent profitability. A buyer or investor will look at your profit history as the foundation of what your business is worth. Second, systems and processes. A business that depends entirely on you, the owner, to function has very little transferable equity. But a business with documented systems, trained staff, and repeatable processes has significant value because someone else can step in and run it. Third, recurring revenue. If you can build subscription models, retainer agreements, or long term contracts into your business, you'll dramatically increase its equity value. Now, here's the practical takeaways for early stage business owner. It's never too early to think about equity. Even if you're in year one or year two, the decisions you make now, how you structure the business, how you build your client base, and whether you document your processes are either building or destroying future equity. So let's recap the four types of money and the job each one has in your business. So we went over income. Income is the money coming in, it's your engine. The goal is to grow it strategically and understand which revenue is actually worth pursuing. Profit is what you intentionally keep. Keyword intentional. It's your cushion. The goal is to plan for it deliberately, not just hope that it shows up at the end of the year. Flow is the movement of cash through your business. It's your oxygen. The goal is to always have enough liquidity to meet your near term needs without panic. And equity. Equity is the total value you are building. It's your legacy. The goal is to build a business that is worth something beyond the paycheck that it gives you. Here's the thing. These four types of money are not in competition with each other. They work together. Healthy income creates the foundation for profit. Managed profit contributes to healthy cash flow. Consistent cash flow combined with smart operations builds equity over time. It's a system. And the business owners who thrive long term are the ones who understand all four, not just the revenue number at the top of their income statement. If you made it this far, I want you to do one thing this week. Sit down with your financials and ask yourself four questions. Am I tracking where my income is actually coming from? Do I have a target profit margin and am I hitting it? Do I know what my cash position looks like 60 to 90 days from now? And is this the business I'm building actually worth something beyond the salary that it pays me? Those four questions map directly to the four types of money. And just asking them puts you ahead of the majority of small business owners out there. So if you found this helpful, please go ahead and subscribe because every week I put out content designed specifically for small business owners and entrepreneurs. Practical financial education without all the jargon. So, and if you're at the point where you may need a CPA who actually understands the business side, not just the tax side, feel free to reach out. My link is in the descriptions, and I'll see you in the next one.